Welcome to the Deep Dive. Today we're taking a fundamental run-through of Cohance Lifesciences Ltd. And we're not just looking at a standard quarterly report here. We're really trying to understand a company that has been fundamentally reshaped by some major recent corporate mergers. I'm talking about the Cohance scheme and the Casper Pharma deals.
Exactly. And that corporate surgery, as you put it, means we just can't take the old historical figures at face value. They don't really apply anymore. So our mission today is to cut through all that complexity, the restated financials, the adjusted numbers, and use the latest Q1 and Q2 FY26 data to really see what this new unified company looks like.
Right, we need to assess the core business, how efficient it is, and I think most critically, whether their very ambitious long-term strategy is actually credible, especially when you see some of the red flags we're going to talk about.
Absolutely. The complexity demands it.
Okay, let's get into it. Let's start with the company engine itself. So Cohance is a big player in the Indian CRAM sector, right? Contract research and manufacturing. What is Cohance's identity now? What do they actually sell?
Well, Cohance is a specialized CDMO that's a contract development and manufacturing organization based in Hyderabad. They focus on something called new chemical entity development.
Okay, so what does that mean in simple terms?
It means they work for the big global pharmaceutical and fine chemical companies. They support them from the very earliest stages, R&D, all the way through to making the final product on a commercial scale.
So they're essentially a highly sophisticated, outsourced factory for drug innovators.
That's a great way to put it. They operate under three main pillars. There's pharma, CDMO, specialty chemicals, and something they call API Plus. But what really matters is their market position. They're considered one of the top 5 Indian providers of these high-end, complex ingredients to global innovators. They're not just stamping out generics. They're in the deep end of the pool.
Being a top 5 supplier is one thing, but that CDMO space is incredibly competitive. Success really comes down to the moat, right?
Yeah.
What makes Cohance so hard to copy?
Their moat is all about technology. It's built on a deep expertise in niche, high-growth areas that require some extremely specialized and expensive infrastructure. We're talking specifically about 2 areas: antibody-drug conjugates, or ADCs, and the building blocks for oligonucleotides, which are used in mRNA therapies. That's where the real high-margin work is.
And ADCs are a huge growth area in cancer treatment. What's their specific play there?
So in the ADC world, they are global leaders in what are called camptothecin payloads. These are incredibly complex, highly toxic molecules you need to build the final drug. They already supply these for 2 commercial ADCs that are on the market right now. And to back this up, they've been investing heavily. They bought a U.S. company, NJ Bio, to expand their bioconjugation capacity.
Yeah.
And they've built these special high-containment OEB6 facilities in India. That's the highest level of containment you can get.
So that integrated chain making, the really complex toxic parts in India, and then doing the final assembly, so to speak, in the U.S., that sounds like a huge strategic advantage for global pharma clients.
It is. It offers them a single integrated partner for what is a very, very complex process. And this integration theme continues with their work in oligos. They have a unique position globally. They are reportedly the only commercial supplier of something called tricyclo-DNA amidites in the entire world.
The only one.
The only one. Being the sole supplier for a key building block in a really fast-growing therapy area gives them, massive pricing power. It makes them pretty indispensable in that niche.
That distinction is so important. That's the difference between being a commodity supplier and a true strategic partner. Okay, let's shift gears. How does all this translate into actual financial performance? Let's look at the income statement. Cohance's revenue story is, well, it's volatile. You see negative 3% compounded growth over 3 years. But then the trailing 12-month sales growth is 44%. That's a huge swing. What does the latest quarter tell us?
That volatility is really a reflection of the massive transition they're in. For Q1 FY26, revenue was about 5.49 billion rupees, which is a reported 13% year-on-year growth. But, and this is a big but, management insists that if you adjust for inventory destocking,
Which is when customers just use up the inventory they already have on hand.
exactly, they say if you adjust for that, the real underlying growth was actually over 25%. And if you just isolate the pharma CDMO part of the business, growth was over 30%.
Okay, that destocking explanation is something we hear a lot in the sector right now.
Mm-hmm.
But let's assume the underlying growth is strong. What about the quality of that growth? Is the niche strategy actually showing up in the top line?
It is, and that's probably the most positive sign right now. The contribution from those high-margin niche technologies, the ADCs and oligos we talked about, has risen pretty sharply. It went from the mid-teens in FY25 to over 20% in just the first quarter of FY26.
Okay, so the strategy seems to be working on the revenue side.
It indicates that the big strategic investments are starting to pay off with the right kind of product mix.
Great. Enough of the hard part. Let's talk profitability, because that's where the stress really seems to appear. We've seen some serious margin compression. Let's start with EBITDA and PAT trends.
Right, let's focus on EBITDA. And for our listeners, that's earnings before interest, tax, depreciation, and amortization. It's really the true operational profit, before all the financing and accounting choices. Their adjusted EBITDA margin dropped from 27.6% in Q1 of last year to 23.9% in Q1 of this year.
And margin compression is never ideal, especially when you're supposed to be in a high growth phase. Management's line is that this is due to planned strategic investments. Do we buy that?
Well, we have to look at it critically. They claim they're spending aggressively ahead of the growth curve. So investing in that oligo and ADC infrastructure, hiring top talent like the new CDMO CEO, Yonder Herve, and of course, bearing the costs of integrating NJ Bio and Sapala. And look, these are all necessary costs for growth. But the question for an investor has to be, when does a planned investment phase just become a recurring structural cost? These integration costs have been hitting the margins for several quarters now.
And what about the final bottom line, the PAT?
PAT, or profit after tax. That's the final profit that belongs to the shareholders. That margin saw an even steeper fall. It went from 17.1% in Q1 last year, all the way down to 11.4% in Q1 this year.
So even if the fancy niche products are helping the gross margins, all the other costs are just eating up the profits before they hit the bottom line.
That's it in a nutshell. The operating expenses and restructuring costs are overwhelming profitability at the moment.
Okay, let's move on to the financial health check, the balance sheet and cash flow. With all this ambitious spending and M&A, how stable are they? Are they piling on debt?
Surprisingly, no. The structure is actually quite robust right now. As of the first quarter, the company is fundamentally net cash positive to the tune of 2.44 billion rupees.
Net cash positive. Okay.
Yeah, it means their cash reserves of 4.4 billion rupees easily cover their total borrowings of about 1.96 billion. And this strong capital base is essential because they are still spending heavily. They put 559 million into CapEx in Q1 alone.
So liquidity is healthy. That's a good buffer for a company in this kind of transformation. Now, what about managing the money once it's earned? How's the working capital situation?
On one hand, they've shown good progress. Core net working capital actually declined 18% year on year, and the number of working capital days fell to about 74. So that's an efficiency gain. However, this is where we find a major red flag kind of hidden in plain sight. We have to look at debtor days. That's the time it takes for their customers to actually pay their bills. That number has shot up dramatically. It's almost doubled, from 46 days in March 2024 to 87 days in March 2025.
87 days. Wow. Doubling the time it takes to collect your revenue? That signals a massive cash quality issue. Even if you're net cash positive today, that kind of slow collection can become a huge problem tomorrow.
It creates enormous stress on the system. I mean, it's great that they generated positive free cash flow of 2.3 billion rupees in the first quarter, but those 87 debtor days really undermine the quality of that cash generation. It suggests they might be having trouble with customer negotiations, or maybe there's a risk of bad debt creeping in. If you have to wait nearly 3 months to get paid, it really limits your ability to reinvest that cash. This is a trend that needs to be reversed, and quickly.
Absolutely. That spike warrants some aggressive monitoring. Let's move to the ultimate check for investors. Capital efficiency. We're talking return on capital employed and return on equity.
Let's start with ROCE, or return on capital employed. This basically measures the return you generate on all the money invested in the business, so debt and equity combined. And Cohance used to be incredibly efficient. They delivered a 41% ROCE back in March of 2021, but that fell off a cliff, down to just 15% by March 2024.
That is a significant drop. What does the picture look like now after all the recent mergers?
The latest adjusted ROCE for the first half of this fiscal year is sitting at 21.7%, and this number is crucial to understand. It's depressed compared to those historical peaks because of what you might call the great bet. Management has poured hundreds of millions into new plants, specialized facilities, and acquisitions. Right now, those are just assets sitting on the balance sheet, not generating revenue yet, and that actively pushes the ROCE number down until they get utilized.
So the lower ratio is a direct reflection of that strategy. Invest heavily now for a payoff later. What about for the shareholders specifically? What's the ROE?
ROE, or return on equity, measures the profit for every rupee a shareholder has invested. The adjusted number for the last 12 months was 17.7%. Now that's respectable, but again, it's below their 5-year average of 21%. The synthesis is pretty clear. All the efficiency ratios are being temporarily suppressed by the huge capital and integration costs needed to transform this company into that specialized niche technology platform.
Right. Let's look to the future then. Section 5, Strategy, Guidance, and Flags. The long-term vision is massive. They're aiming for $1 billion in revenue with mid-30s EBITDA margins by 2030. How are they trying to execute on that?
Well, they're focusing on bringing in top-tier talent and governance. They hired Mr. Jan de Herve as the CEO of the CDMO division, who has deep global experience. They've also set up an external advisory board with 5 global pharma leaders to guide strategy. And the pipeline is moving. They got a US FDA approval for a small molecule, and they have 2 phase 3 drugs that should become commercial products in the next 12 to 18 months.
Those are strong strategic moves. But the immediate picture is pretty cloudy, especially with that severe downward revision in their financial guidance. What happened? What forced them to change their targets so drastically?
It was really a perfect storm of setbacks, both internal and external. They revised their FY26 revenue guidance down to basically flattish year on year, and the adjusted EBITDA margin target was cut to the high 20s, which is a huge drop from their earlier guidance of low 30s.
And the reason?
3 main things. First, that inventory destocking we already talked about. Second, and this is a big internal execution risk, their Naturum plant had a temporary shutdown because of a negative audit finding. It's only just starting to resume production. And third, the broader slowdown in biotech funding has delayed shipments at their U.S. facility, NJ Bio, by probably 2 to 3 quarters.
That Naturam shutdown is a clear internal failure. That's not market conditions, that's on them. And that is concerning. But let's get to the most explicit governance risk, because there is one structural issue here that you just cannot ignore.
This is the biggest red flag in the entire story. On one hand, you have these world-class, unique assets. On the other, you have fundamental questions about financial risk. Our sources are very clear. The promoters have pledged or encumbered 100% of their shareholding. And on top of that, the promoter holding actually decreased by almost 9% over the last quarter.
100% pledge. That's the highest possible structural risk. It's maximum leverage. For our listeners, what does that level of pledging actually mean for the stability of the company, even if it is net cash positive right now?
It means the promoter's entire financial position is hanging by a thread tied to the share price. If the stock price takes a significant hit for any reason, the lenders could issue a margin call, forcing the promoters to sell shares to cover their loans. That forced selling could just push the stock down further, creating a downward spiral. It creates a massive uncertainty overhang that has nothing to do with the quality of their science or their assets.
And we keep seeing these recurring one-time expenses crop up, RBI fees, M&A costs that never seem to end. When you put all that together, the messy financials, the 100% promoter pledge, the spiking debtor days, it really paints a picture of a company whose financial management is struggling to keep up with its technological ambition.
Exactly. The company has a Ferrari engine, but it feels like the financial dashboard is flashing warning lights all over the place.
So let's bring it all home. We need a balanced, synthesized view. Can you distill this entire analysis into the 3 core positives and the 3 core risk factors for Cohance Lifesciences?
Sure. On the upside, number 1 has to be the strategic focus on niche modalities. Their leadership in ADCs and oligos is real, and it's showing up in the revenue mix, which is now over 20% from niche tech. Second, despite all the spending and the cash collection issue, they still have a robust financial foundation. They remain net cash positive with strong recent free cash flow. And third, they are actively strengthening their global platform with a good late-stage pipeline and by bringing in experienced global leadership.
Okay. And what are the 3 risk factors that a listener absolutely must keep an eye on?
First and foremost, promoter governance concerns. That 100% promoter pledge is a critical structural risk. Full stop. Second, near-term volatility and execution risk. The revised flattish guidance, driven partly by internal failures like the Naturam shutdown, shows that operational stability is still a huge challenge. And third, cash quality and margin pressure. The huge jump in debtor days to 87 and the constant drag on margins from one-time costs point to serious working capital stress and an inability to turn profits into quality cash efficiently.
And this is where it gets really interesting for you, the listener. The Cohance story is a high-stakes play. It's centered on this great bet, investing a huge amount of capital in these differentiated technology platforms today to become an indispensable global partner tomorrow.
The question is, can the new management team actually execute the massive ramp-up needed to turn all that spending into high-margin revenue? Or will these persistent short-term execution challenges, especially the governance red flags and the working capital stress, continue to undermine what is, at its core, a fundamentally sound and specialized long-term vision? It really is a race between ambition and basic operational stability.